Don't even think about making a multifamily investment until you've watched the last episode of the Gray Report. What we're covering: inflation, new print on the CPI today. Inflation is coming down. Are we going to see rate cuts this year? I'm not sure. I think it's going to be in January, but we're going to talk about it and how it affects real estate and multifamily. Also, we're going to be talking about a little bit more of these office to apartment conversions. Going to be looking at an example here in Indianapolis. It's trying to get a ton of public dollars to see if they can make it happen. But does it make sense? And is it a good investment for municipalities and cities to invest in these types of developments? We're going to discuss it. And then from CBRE, some distress will emerge amid a wall of loan maturities. You know, we've been talking about it for the last year and a half here on the Gray Report. We put out some of the first reports touching on this subject. We're going to get an update from CBRE and then from Moody's Q1 2024. We're going to be looking at some of the top and bottom multifamily markets. Which ones are moving? In what direction are they going? Lastly, from Yardi Matrix, we're going to be looking at some secondary markets. We're seeing a lot of rent growth in some of these not massive cities that may have been overlooked by developers, and now renters are moving in there. They're not seeing nearly as much supply, and rents are increasing. Again, you're going to want to have a good understanding of all these pieces before you make any type of investment in 2024. Strap in. We're going to have a great episode. Let's get into it. Welcome back to the Gray Report, joined again by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. And Matt, it is your birthday. Happy birthday.
Hello. Thank you.
This is an exciting day.
25 years old.
25 years old. Good. You know, I forgot how old I was. I was off by a year.
Yeah.
I keep saying I'm a year older.
Yeah.
Because I'm trying to make myself feel older.
Because you're kind of prepping yourself.
Exactly. Mentally preparing myself.
Yeah.
And then I'm not disappointed. And then I'm like, wow, right. I've gotten younger a year. I'm sure.
Yeah.
Similar.
Nope.
Thing.
Yep. I hear you. That's 40 years old. It's tough, but
it's a 4-0.
Yeah.
It's a big deal.
I know.
The big 4-0 around. What? Tell me. Give me. How do you feel? What are your thoughts?
I feel like I'm not celebrating this. I'm not gonna have a huge party, and I'm just gonna accept it. It's fine. I keep thinking we're in a generation that's gonna live forever, right? We're gonna get our brains in computers, and millions now living will never die. So
that's true.
So
I think
I'm not worried.
Boomers definitely, at least, are still thinking that. Also.
Oh yeah, they'll figure it out for sure.
Yeah. So they're hoping that we figure it out.
Yeah, that's right.
All younger generations putting it on us.
Yeah.
Matt, well, happy birthday. It's really exciting.
Thank you.
Let's talk about inflation. Let's get this over with.
Oh, yeah.
This is the big chunky piece is what we've been anticipating again, because CPI, it's not necessarily the top item that the Federal Reserve looks at, but the public looks at it, market looks at it, and it's certainly an influence to the Federal Reserve, the Consumer Price Index, generally that gauge of inflation. Just to get people up to speed, the controversy this last year and a half has been how real estate, specifically rents, are factored into the CPI number. It took a year for CPI, Matt, to capture the rent increases that took place during really 2021, and now we saw rent declines at the end of 22 and really through 2023, but we have never seen that renters equivalent. Shelter equivalent in CPI actually come down and be negative. It is still increased and compounding off of those major increases we saw, more than a year and a half ago. And so every month when this CPI number comes out, market watchers, analysts, real estate investors are looking at this number to see when it's going to come down. Because again, we know rents were down last year.
Yeah.
We're looking for it to show up in CPI to give the market an indication that inflation is cooling, but it's stayed stubbornly high, and the shelter component of CPI makes up over 1/3. So it's a major factor. And then I'm going to just turn it over to you because you've done a great analysis.
Yep.
But one piece that I think really is a stark contrast from if you hear, inflation is still very elevated, we're in the 3 to 4% range. If you take the shelter component out of it, and then volatile food and energy, inflation year over year, we're at 2.2%, which is, 10 basis points away from the Fed's target at 2%.
Yeah.
The Fed is aware of this. And so now they're communicating a little bit differently because they don't want the stock market to get, over its skis, because that can be inflationary also. Because if they signal too early that they're going to lower rates, and they have to ask themselves, do they really need to lower rates when the stock market is, at all-time highs?
Yeah.
Unemployment is still low, although the unemployment rate has ticked up a little bit, and wage growth still positive, outpacing inflation, has ticked down a little bit. But we're kind of in a sweet spot, so it doesn't seem like we need to do anything that drastically.
Yeah.
Getting into the details, Matt, what were some highlights that you saw in this latest CPI print?
So yeah, I'm glad you did mention shelter. Let's see. We're at 5.6 rental inflation. Now, this is rent of primary residence. And the pre-pandemic average for this rent of primary residence figure was around in the upper 3% range, like 3.5 to 3.8%. So we still have a couple percentage points to go. We're essentially from the 8% peak that we had in I think it was 2022 or 2023. There's a graph actually of rent of primary residence that I pulled off of the Fed here. But I'm sorry, it's just one tab over. That shows how much of how much we have to go and when it peaked, which was I think it was March 2023 actually. But again, this inflation has been sharply decreasing since that time period. And you can see it has been really going down. It's just not there yet.
Yeah, and this is the rate of growth. The percent change year over year. So it has definitely declined all the way up from 8.81, as you said, Matt, in March of 2023. We're down here 5.4% as of April of 2024. But again, we know that in March of 2023, most of the nation had negative rent growth.
Yeah.
I mean, Austin, Texas was negative 7% rent growth even the last couple months. So we know we've seen a correction in rental rates. We've seen a correction in multifamily asset values as well. We're just waiting for this to all show up in the numbers. But again, it's something that we all know has already happened.
Yeah.
But we're waiting to see when we're going to, it's going to be crystallized and printed on CPI.
Yeah. And another point here is there could be a reaction. So it's a couple points that we have to go to get to the pre-pandemic average, but there's a very good chance that it will get under that we will have annual inflation below 3.5 to 3.8% just because of this rubber band effect of rents that we've seen in the private market rent reports that were outside of the CPI. So really good news there, but again, slow going.
And I'm glad you brought that up, Matt, too, because I've been thinking about that. We may find ourselves in a period. Well, we actually are finding ourselves in a period now that rents are starting to kind of pick up a little bit in some markets. We're getting into leasing season.
Yeah.
And so there's going to be an environment now where we're actually in reality, we're seeing rents grow moderately, but then CPI at some point is going to show rents maybe not being fully negative, but much lower. And so then the conversation is going to be like, oh my gosh, there's been a slowdown in the economy.
Yeah.
And, wow, shelter and real estate are in the, in the gutter. And it's going to be like, that was a year and a half ago.
Yeah.
We were talking about it on the Gray Report a year and a half ago. That's past. So it's kind of like we have a little bit of like a time machine, but we're not sure where we're living.
You know what I just thought of? It's like, did you ever sing in a round in music class, row, row, row your boat? Yeah. We're at the end of the song and they're just starting the beginning, or maybe they're in the middle, but we know where this is going.
The canon.
Yeah. merrily down the stream. We're already down the stream and they're still rowing. But yeah, that's about as far as I'll take that nautical metaphor. I'm sure we'll come up with more.
It would be good. It would be good if they were in time.
Yeah.
If we knew that they were a whole
that's
4,
a good point.
8, 12 bars behind, we would be able to predict. But that's been the challenge. Is every single month we're market watchers have been waiting.
We
for
know it's coming.
We know that it happened. Again, it's in the rear view mirror. We know it happened in reality. It's just the long tails on these numbers are frustrating. And again, thinking back last month, Matt, when again shelter was really elevated, it was kind of a upside surprise to the downside. And again, I'm just scratching my head because the bond market shot up. Treasury rates went all the way up. 10 years, 4.77 some percent. And we're like, guys, this number. We're all making all these major, billions of dollars are trading hands,
that's
trading.
A good point.
I'm like, are we serious? And so now, the 10-year Treasury today is down at 4.33%. So the market is finally picking up on it. But again, it's like the bond market's supposed to be the smart money.
And
how smart can it be?
Yeah. That's
smarter than us. But we know this is the thing. We know this. We have a narrow niche. It's real estate, commercial real estate, specifically multifamily. And the things that touch that. Anywhere else, I need to listen to somebody way smarter. And I try to listen to smart people just in our space. But there's way smart people than me or you.
Yeah. Hey, bring up Jay Parsons if you want
to. Exactly, because Jay Parsons, we featured him. We feature him frequently because he's a voice that I think we really respect in the multifamily industry. Does a great job of summarizing what's going on. You can see my dog is trying to get into the podcast studio, Matt.
Oh, that's fine. This is a good distraction, I think. I am trying to bring that up for you as well. All right.
Okay. So Jay does a great job, and he states a lot of what I just stated. Again, how they calculate CPI. It's a survey of about 7,000 renters each month. I mean, that's like a fraction of renters that are actually out there. So it's kind of silly that it's not same store data also. But either way, I wanted to look at this graph that he highlights. Basically, again, showing that if you take out shelter from inflation, because the shelter figure is a little, it's not giving us a view of where inflation is today.
Yeah.
There are some use cases. I haven't really heard a good argument of like why this is the best, other than like, no, there's reasons for it. It's by design. Okay, why did you design it like this way? But anyway, again, we saw this huge push. It makes sense. We all know this. This is the inflation, during COVID. This is this, I hate to use the word transient because it's not really a transient, but it kind of is, even though the Fed, it's much less transient than the Fed wanted it to be. But, we're at 2.2%.
Yeah.
We've had, and this is Jay Parsons' point. We have had 12 consecutive months of around 2%. Inflation, if you're going to be looking at it like this. And we know the Federal Reserve is at least taking a look at it in this vein as a part of the lexicon. I just think their concern, though, Matt, is they know too many people. The economy's doing pretty good even with higher rates. And even, today with CPI, the stock market is going up. I saw the VIX was down 6% just as we were recording. Bond rates are down. And so even and this isn't like a massive downside surprise of inflation kind of, moderating down. This is just, all right, it's not like coming away from us. It's not running.
Yeah.
And markets are reacting in a huge way. So so the Federal Reserve almost has to kind of keep psyching everybody out, being like, I don't know, guys. We're not sure. We need more data. We need more data, and we're concerned about it now. So you just need to hold your horses, but you're going to screw everything up for us.
Yep.
And again, I think it's, and like I said, I think January, unless if we see some really slow, we see a lot of slowdowns during the summer, which you should see growth. Then I think maybe this year. But without that, again, I'm targeting first quarter 25, January for a rate cut, and
and
that's not a bad thing. I think that's the base case.
But like credit and spending, we talked about that last week. They are kind of tapering in terms of their growth is tapering. And we'll see how that pans out for the summer. It's never a perfect journey to deflation or to lower inflation, because that means people are spending less. Maybe people are making less, or the job growth is a little less strong than it was before. So there are some sacrifices, but it does seem like things are heading in a positive direction, much more than they were in like 2022 or 2023. But we'll wait for sentiment to roll around. I do want to give top line figures though.
Break it down.
So overall inflation was lower in April than it was in March. Last month we were worried about that stifling 0.4% monthly increase. This month it's up 0.3%. It's an improvement. And the year over year numbers also improved for overall inflation from 3.5 to 3.4. Also, if you do core inflation, which it's not like the super core that we just looked at, it's
just minus food and energy. You got housing still in there. Yep.
And it moved from 3.8 to 3.6 year over year. So basically moving in the same direction, almost at the same point as overall inflation. And the monthly movement was the same from 0.4 the previous month to 0.3 in April. So improving numbers there. Really good news. I hate to say it though. Egg prices. I know a lot of people were almost happy to be mad about egg prices last year. I don't know if you remember, those
I remember we covered it.
Anxious weeks before Easter of 2022 or 2023. It seems like every year we're talking about eggs, but they're actually down.
You're talking about eggs, man.
I know, I do. That is like my stereotype, or I don't know, for people that complain about inflation, and it's like this arbitrary thing. Oh, well, with bread prices nowadays, how can anyone do it?
Yeah.
And like, oh, whole wheat's up 9.8%. Well, eggs are down 7.3% in the last month, and they're down 9% since last year. So can't talk about eggs anymore. I don't know.
Well, there's some bird flu fears going on.
Oh man, those are gonna jump those egg prices back up.
Yeah, so I don't want to go off on too much of a tangent.
Not gonna count my chickens then.
Oh man, they just keep rolling.
Yeah.
No, but it is serious. I think because and that's the difference between, I guess, the consumer, how they feel about inflation, which is just as important than as of where actually inflation
and
is.
That's where food
than the
comes
reality.
in, for sure.
That's where food comes in. A lot of complaints, and then just it takes a while to get used to just higher prices, higher than they were a couple of years ago, and so that affects everyone's mentality, and they're frustrated. And I think that that's leading to the sentiment of, it's a tough economy, because there are tons of people, the majority of people who are living paycheck to paycheck, and that increase, whether it's in gas or it's in utilities, food, everything. Because obviously rent has gone up, it's moderated, but it's higher than it was a couple of years ago.
Yeah.
And so your wage has gone up a little bit, but we're saying broadly in the United States, wages have outpaced inflation.
Yeah.
Well, that doesn't mean everybody's wages has outpaced inflation. Some have probably far outweighed it, and some have probably, underperformed relative to inflation. And then they're looking at their bill, the bill at the end of the month, and their bills, and what the check is when you go to the grocery store, and it's frustrating.
For gas specifically, and this is another good point, gas was up. It's still on a tear, up 2.8% in 1 month.
Wow. I think that if CPI came down, it was this week, and energy prices are pushing it that much.
Yeah.
That really, I think, is a pretty good data point for the Fed to look at, saying, okay, we could cut rates if we feel like it's not going to toss too much, napalm on the backyard campfire.
Exactly. And what you said before about how markets are so reactive to everything the Fed says. I know that when he was making those comments yesterday about how he's still nervous and how he still wants to keep rates a little bit high, I think that he went into that knowing that even if CPI was great, his opinion wasn't going to change on that point, because everyone's just so reactive.
I'd love to know how they lock down or not those reports before they get released. Because we've all seen the Trading Places movie. The pork belly and frozen concentrated orange juice futures, getting that crop report in.
Yeah.
But obviously it's major market moves. But does the Bureau of Labor Statistics puts together the CPI report. Obviously, they have people working on it. I was just fascinated because you get some inklings the day before. I know yesterday there were some thoughts that this may happen.
Yeah.
And so and I think that there are other ways you can kind of reverse engineer CPI because they have all the weighting. So if you can understand where all those different segments are, you can probably get pretty close. Generally, are energy prices up? The things that aren't lagging as much. But it always just fascinates me.
Yeah,
because,
that is interesting.
Did Jerome Powell know that there was going to be maybe a moderately soft CPI print, and would that influence his discussions? Is he privy to that information? Earlier.
That's a good point.
I don't see why he wouldn't. Why I understand that there are all the reasons why you wouldn't want to release it publicly. But for policymakers, you'd think that they could have some more higher frequency access. I don't know.
No, that's a really good point too.
We're working on somebody from the BLS to come on, and
I my outreach campaign is still ongoing. But I would love to know. We
get a janitor. I don't know, somebody.
Yeah, exactly. I still like the idea of your friend of a friend that works at the St. Louis Fed. making policy suggestions.
Yeah.
I
What do
like
you guys
that
got
idea.
going on over there? Yeah, I think that's friend.
Yeah.
Or know somebody. We've got the connects. We'll figure it out, Matt.
true.
Okay. Anything else on CPI
that's about it.
and inflation? And I wanted to summarize kind of maybe like how this affects multifamily and investors before we move on.
So to steer back towards that and the implication, I think that a CPI report like this is helpful. I know Jerome Powell made those dampening comments and was like, "Oh, don't get too excited." And whatever, I think that this is solidly good news for multifamily, and even apart from the implications for interest rates, which are a lot more rosy. That's a lot more optimistic now. Even apart from that, the fact that renters are not going to be weighed down by other inflationary forces as measured in the CPI is a good sign. So all good.
No, I think those are all really good points. I think it's overall generally good for the consumer.
Yeah.
If you are looking at making a multifamily investment, buying a multifamily property, investing in a syndication, I think that the base case needs to be, interest rates just stay where they are.
Yeah.
And if you're looking at a deal, you can't have it reliant on interest rates coming down materially. I think that right now, the litmus test is if nothing changes, does the deal still work? But then at the same time, you have to. I think that the reality is, because you want to avoid over speculating. But if we want to understand, using the Wayne Gretzky overused phrase, if you want to know where the puck is going, and every data point, we cover this throughout the week, every week, every piece of data point is saying that, we are moving towards more of a normalizing growth rate, closer down to the Fed's target. Like we are moving on that direction. Again, part of that is our knowledge of the rental market and how important that shelter component is to CPI. And if that's the one thing holding it up, it's just kind of, okay, the emperor's not wearing any clothes and no one's just ready to mention it just yet. There's a high probability, I think, rates will be lower in the future than they are today. Now, whether that's 9 months or 18 months or 24 or 36, I'm unsure. But I'm if I was going to bet, and in some ways I am betting, that we are going to see cap rates starting to come down. Not right away. This is not the time to get into short-term deals. Because you could have the right idea. You could buy an asset at a great price, but if you need something to happen in 12 months, 24 months, you could just you're going to
I was going to say
easily be caught between a rock and a hard place.
You know where it's going, but
it could get worse. It will probably get worse before it gets better. There's still multifamily delinquency in terms of mortgage payments. All those still, I think, well under 1%. So it's a small portion of the market, but it is increasing quite a bit. We're going to talk about the loan maturity wall. Basically, got just kicked the can down. The can has been kicked down the road. And it's fine right now today. But, again, if there's no relief, there are going to be owners that are going to be more distressed than they are today. But generally, I think we should look back over the last 24 months or so and be pretty impressed with the resilience of the multifamily industry. If we can get through this type of interest rate shock, multifamily, again, nothing's absolute, Teflon. There's always ups and downs. You can have bad operators, bad strategies. You can always overpay. You can always run something into the ground. But overall, and generalities, multifamily has really been able to stand up through the pandemic. I mean, we got through the pandemic and that recession better than ever in weird ways that messed everything up and a lot of different reasons. But got through it, getting through a interest rate shock, the highest increase that we've seen in decades, and then to get through the supply shock that we're going through right now. More deliveries this year than since 1974, man. If the industry can get through all of this, again, not that it was all roses, not that there haven't been bumps along the road, and not there have been foreclosures and investors who have lost all of their equity. That has all happened. So again, nothing's perfect, nothing's without risk. But if you look as a broad whole, industries have been doing pretty damn well. It should give us a lot of confidence for the next decade. And if we're at the low point now, Because values are down 20 to 30 some percent. They're going up.
And construction is down too.
And construction is getting ready to, not grind to an absolute halt, but go down to below pre-pandemic levels near the end of 2025, setting up a really exciting environment. I think it's a great time to get into multifamily.
Yeah, things definitely, and maybe this is how markets always work, but it does seem like, there was a little bit of a crisis of overbuilding or maybe an overexuberance. But now it is balancing really quick, and it's a surprising amount of demand that I don't think everyone was expecting. I think it would be fair to call this amount of demand, especially after 2022, excessive. We've got excessive demand, and we have even more excessive supply. One of those is finite. I think it's the supply, and I think that makes the long-term prospects of the apartment market really, really promising.
Yeah. So strap in. I'm putting my money where my mouth is. I'm going all in on multifamily this year.
Yeah.
From going on the debt, putting pretty much all the cash I have into these deals, and then can invite a group of investors to go alongside with us. So if you are a credit investor, you want to learn more, hop on over to graycapitalllc.com. Have a meeting with me and the investment team. Love to tell you about our new deal that we're going to be launching here in the next couple of days. In Indianapolis. Really exciting.
Yep.
So let's talk about apartment.
More about Indianapolis.
Huh?
Talk more about Indianapolis.
We're going to talk a little bit more about Indianapolis. So often, not infrequently, Matt, we talk about office to multifamily conversions. Great. It can be it's a great idea in theory.
Yeah. It's fun to
what are we going to do with these buildings? Maybe people are working in their office less, which, by the way, I think people will be working in offices more than people think. That's just my take. But hey, we got these big office buildings. They're empty. What are we going to do with it? One example here in Indianapolis that was on the news recently in the Indianapolis Business Journal, which is a great publication. If you want to learn more about what's going on in Indy, I'd highly recommend getting y'all's a subscription to the IBJ. But they put out a timeline for converting the Gold Building in downtown Indianapolis, which is an office building, I believe built in the kind of the late 70s. They're going to convert it to apartments as construction costs climb. Now, I remember when this is a rendering. It's a very gold reflective building. They're the plan. I remember when they bought this building. I think back in 2018, 2019.
2019, yeah.
Yeah, 2019. They were looking at really as a kind of a value add office, play. And part of it was they were going to, take I don't know if they have a picture of the gold on this article. I don't think they do. I wish they did. Because it's called the Gold Building. They only have the rendering. They were going to turn the gold and make it a little bit more modern and kind of have this black reflective look, which I think it would been fine, but this is kind of a traditional office play.
I gotta say it. How much money are they really going to save by turning the Gold Building into not the gold? It's a gold reflective surface. I understand it's probably a little more expensive than a mirrored silver surface, but it's called the Gold Building. You're losing a little bit of branding.
I agree. I guess it screams late 70s. I guess modernize it.
Yeah.
Do you want to? I think the idea is you're going to arbitrage, what the rates, the office rates of like an older building without amenities, versus to the newer A-class stuff. Let's make it look like a newer building. Let's add some amenities. Indianapolis occupancy was pretty decent back in 2019. So let's lease it up and we'll buy it at a low basis. That was the original plan. Not a crazy idea. There was a lot of B-class value-add office plays that were going on pre-pandemic that made a lot of sense because the cap rates were relatively high.
2019.
It didn't seem too crazy. I never got into it personally just because office can be volatile and but I'll admit there were times where I've been tempted to look at some office buildings that they were great value, but I've had some mentors, people tell me just don't get in the office. Yeah, and I never really did. But anyway, so they raised a bunch of money, invested, bought this building to convert it to offices or to do value add office. Now they're looking at spending $200 million to transform the building into 354 apartments.
Their initial thought was it was going to cost $120 million, but now they're thinking $200 million.
Yeah. So it's going to cost 120, now 200 million. So at the same time, and this is a little bit inside baseball, but there's a like really nice A-class apartment building of a similar unit count.
Yeah.
That is, I think it's a 2014 construction. It's got a grocery store anchor. Mm-hmm. It's in a prime spot downtown.
Yeah.
They're trying to sell it, for plus or minus. It came out for over $100 million, like $115 million. Trying to sell
per unit price for that? Ballpark.
Call it around 300 or less, like high 200s, low 300s. So I'm trying to remember the unit count.
So that 200 million. Now, part of it's a parking garage, and I'm not sure how much how that would be calculated.
Well, but there's also there's a grocery store there also that's included in that price.
In the gold building price?
No.
Oh, in that price. Okay.
This other property.
Okay, so let's just pretend that they're equal. That 200 million divided by 354, that's probably a higher per unit price, maybe almost twice the per unit price of the gleaming tower.
So that's $564,000 per unit. It does not include, again, they this is on, I believe, they've already bought the building.
Yeah.
And the last conversation I heard is that they were like, they don't even know what it's going to cost to convert it. They're like, they need to get in there to figure it out. Mm-hmm. And so again, they've already put, I don't know what their total basis is, but it's just if the 200 million that they're asking for,
that's what
I think mostly from the city, it's $564,000 per unit. Now, Matt, you'll remember we sold in 2022 a property that would set the record for the highest per unit apartment price in Indianapolis.
Yeah.
Timed it right. We got a little lucky.
Yeah.
It was a lot of work. That was at $414,000 per unit.
Yeah.
So this is well over $100,000 more than the highest apartments that were ever sold. Now those were like built. Those are huge units, 2,200 square feet, twice the size of a normal apartment.
They were ridiculous.
They were crazy. I mean, they had your beverage coolers.
It was like the nicest apartments I've ever seen.
They were really, really nice. So like it kind of made sense. It wasn't really comparing apples to apples.
Yeah.
With your traditional apartment buildings.
So what we're seeing here is kind of an overpriced project.
Maybe by double. Yeah. And so here's where the rub is. And again, the developers are, they're really smart. They're a good group of good developers. That's just I don't see why the city would throw $200 million at a project. I mean, we've got apartment projects, that make a lot more economic sense to provide housing.
Well, here's
I'd love a $200 million check to do something, but is this the solution? I can't imagine that knocking this thing down and building from ground up would be cheaper.
That's what I was thinking. I almost think that all of the stuff that we talked about before as like, oh yeah, this emotion. There's an emotional connection to the idea of office to apartment conversions. I know you can't stick a price tag to it, and I know it's illogical. But like, people think, oh, there's a lot of offices that aren't being used. Let's flip them.
Makes sense.
And that kind of easy to grasp narrative of you're solving these two problems of low office and high apartment. Well, let's just turn these into this thing that we need. I wonder if that's got to be in the heads of whatever government officials they talk to. They're like, oh yeah, apartments.
We read an article.
Good
this is trendy, and let's get a lot of non-real estate people to come up with a plan.
Yeah.
And I'm trying to decide if the best analogy is the classic round peg into a square hole, or if I'm thinking of the image of the car people, like with the magnet in front of it, being held up by the car and being, why isn't this gonna work? tell me why this wouldn't work. And I'm like, okay, well, we can get into it, but it's not gonna work.
I also think of maybe there was like a really nice dinner that they had, and it was very, very persuasive in their lobby.
I'm sure.
I don't know. Either way.
And in general, the mayor, Joe Hogsett of Indianapolis, a lot of questionable decisions, I think, over the last couple of years. And again, just this type of investment when I think there's a lot of other areas that the city needs. I mean, downtown Indianapolis has just seen a record number of apartments being built downtown. And I'm glad we built all those apartments. And a lot of them were financed with TIF bonds and some form of subsidies. And so I think this should be just treated the same as those other developments and shouldn't get too much special treatment. And I just, are we really using, and again, should the mayor be, chief?
And I don't know.
Real estate developer.
I don't know who's. It may not be the mayor. It may be some other government official, and maybe there is another city with another mayor that's doing the same thing. I think that logic would still apply. There's still a kind of romance of this idea of office to apartment.
They're all getting around burning piles of cash in their own respective cities.
And maybe the government thinks, there is something special about this building. We don't want to get rid of it, haul out the garbage, and then put something new in. Although, it does make more sense. I remember in college, I went to Purdue, and it seemed like they were tearing down buildings and building up new ones all the time. And I kept thinking, why can't they just retrofit the existing buildings? Why do they have to tear down and build up? It's just because it does make more sense. I know it's stupid and wasteful.
In those buildings
there probably was.
There's probably asbestos and lead in the gold building.
Based
on the vintage. I could be wrong. I don't know any of this. I'm not wishing a phase 2 on anybody.
They are inheriting another project that was built decades ago, and now they're trying to apply it to 50 years later into a whole new use of what it was, rather than building something that perfectly fits.
And I think the owners, they were like, we've got this major investment in offices. Basically, it's going to go to zero, and what's the lifeline? And then, so props on that. Props on City Mark and Gershman for getting the city to get on board. And we could be completely missing something about this. Maybe there's a component that we didn't read and that wasn't in the article.
So this is where I kind of landed and what was like, oh well, this is interesting. So Gershman and City Mark control that property right now. And their plans, and so what they're trying to decide is, what do they want to do with it next? None of the options say, we're going to give up and resell it, like that building that we mentioned on the Gray Report in Chicago.
I mean, all these office there are case after case of these office buildings trading for 10 cents on the dollar for what they traded for a couple of years ago.
Do you remember
$100 million now it's trading for $14 million?
Remember I think it may have been last week or the week before, a property on the Magnificent Mile was slated to be converted into apartments and suddenly it wasn't.
Then it got foreclosed upon.
I think that there is some kind of art going on here about managing expectations, but also trying to plant themselves as try to suggest the idea of this thing as a done deal. Right now, I feel like they're still trying to figure out what they want to do, but the emphasis in this article seems to be that they're
doing this. They don't. Yes, I think that's good. That's a good.
Less done deal than maybe it seems, but if it was a done deal, it's going to be super exciting, and I can't wait to cover it.
I hope. I hope it works out, and it's a great project. I just I get a little wary when the city starts writing checks, and again that $200 million figure just again jumped out at me. Because I'm like, all right, that's double the value for one of the nicest, newest apartment buildings downtown Indianapolis. And so, it's never going to be a 2024 building.
I bet it's going to be higher than $200 million.
That's the thing. Do they usually come under budget?
Yeah. It's going to be a throwing good money after bad situation if things go poorly, and I hope they don't.
Yeah. No. Absolutely not. Yep. Best of luck. I hope it's a successful project. And again, if I was in their position, I'd be doing probably the same exact thing. Yeah. Of okay, what are we going to do with this? Maybe apartments. Yeah, I get it. All right. Matt, covering a topic that we really went hard on about a year and a half ago, and a lot of it got kind of deferred and kicked down the road. And we're talking about all these loan maturities, this wall of debt, relate not just in the multifamily industry, but man, a lot of multifamily deals were purchased in 2021 on floating rate bridge loans. The values dropped, interest rates were up. You could not get off of those. So a lot of lenders basically kicked the can down the road. They've pooled all these mortgages together in these collateralized loan obligations, or CLOs. Got a lot of investors investing in those, institutional investors. So there's no one wants those to fail. And so a lot of these lenders have been saying, all right, we're going to extend your term by a year or two. We just need to drop down another deposit because we don't want to take a loss on our books either. But,
and
yeah,
I think they know that these apartments are going to be okay.
The fundamental, like a lot of them are leasing up just fine. They're occupied, but some of them many of them are cash flowing just fine. They're covering most of them, the vast majority, they're like 99% are all paying their mortgage payments. Yeah. It's just that they might, that's it. They can pay their mortgage payments, and they would be just crushing it in terms of cash flow in some cases, not all, if it weren't for higher debt service, not higher interest rates. And so a lot of lenders are saying, hey, look, you guys are doing a good job managing the property. You're doing exactly what you said you were going to do and what you told us, told your investors. But, interest rates increased by 500 basis points. Maybe your fault, maybe not your fault.
Yep.
We're in this kind of boat together. We can't have our whole book of loans go bad. So let's make some exceptions to push this can down the road with the idea, as we talked about in the beginning of the show, Matt, of we think the rates are going to normalize and come be lower at some point in the future. Yep. They thought it was going to be the beginning of this year. That didn't happen. So, again, we see light at the end of the tunnel, but there can't be an infinite amount of time.
Yep.
So where are we? And I'd love to hear your take on this article from CPI.
It is funny because we talked about this pretty closely last year. We tracked it and researched it.
Two different research reports.
Just about
widely covered, by the way.
Yeah, just about this time last year, it did seem like we were kind of approaching a crisis, and the crisis, admittedly, didn't arrive at the levels that maybe we anticipated and that maybe a whole lot of people anticipated. However, that being said, I do think that it is a more realistic and persistent factor in the market than people may think about. So interest rates are just as high this year as they were last year.
And I don't. Sorry to interrupt you, Matt, but I guess there's some people would say, okay, nothing ever happened. We heard about this loan maturity, well, nothing happened. Prices are down 30%. Something happened.
Yep.
That's what happened because people were dealing with loan maturity and they had to sell for 30% less. So that is a correction. A price reduction, value reduction of 10% or more is a correction. So we've gone through a correction. I think a crash is, I think 40%. So we're somewhere between a correction and a crash, man. So it's like nothing's happened. A lot's happened.
Yeah.
Sorry.
And
go on.
No, that's fine. That was kind of my summative thought when I was making the notes, is that oh no, this has been a factor. It's not, you don't see a headline fantastic deal, but they're lowering their prices. They are reacting to the market. Prices are perhaps even, interest rates are even a little more elevated than they were at this time last year. Yeah. So nothing's changed on the interest rate side to
everyone wants
to make
to get
it
on
better.
long-term debt right now. No one wants to take out another bridge loan. So it's almost like, Matt, if a tree falls in the forest, nobody hears it, doesn't make a sound, but then you find the tree that's fallen down and you're like, well, the tree's fallen down. There probably was a sound. Can we make some conclusions? But if people are saying, I don't know anything about any tree.
Yeah, we didn't anticipate the amount that the banks would work out these loans or extend them and kind of help the borrowers. However, it is just as much of a factor as we were kind of thinking. It'd be this background factor, and it's got to be. In
the report that you can find at greatcapitalllc.com or just search loan maturity report. It'll pop up. We laid out two different scenarios. It's either lenders are going to extend and pretend, or the rates are going to come down, or not, and it's going to force a lot of selling. And a lot of selling did happen, but not nearly as much as it could have.
Yeah.
Yeah.
Okay, so just to cover a little bit more about what they say here in this CBRE report, multifamily is the biggest portion of loans maturing this year, with $257 million set to mature. Office is the next biggest. Did I say million? I meant billion.
Billion.
And office is the next biggest with 204 billion in maturing loans. But then that falls off considerably in the years to come. And that may be just this projection based on, the current information that they have. That being said, it's far easier for me, and I think probably everyone, to imagine an office property in distress compared to an apartment property. But CBRE, I think it's interesting how they characterize this. CBRE says, quote, "We expect that lenders will prefer to extend many of these office loans rather than foreclose, particularly for assets that would realize large losses like downtown office towers. However, some defaults will occur, particularly in the hardest hit buildings." Yeah, obviously in the hardest hit buildings, but it does seem like they're softening the blow a little bit for the office market. And then it does seem like they do the opposite for their account of the multifamily market, in which they said that there will be challenges with refinancing for multifamily properties as many borrowers took advantage of low interest rates and floating rate loans in 2021 and 2022. They predict plenty of one-year extensions, and ultimately they do give a direct quote. They say, "CBRE expects that lenders will work with borrowers," but they're trying to put these on an even playing field, where I think they are not. I think that office is a lot more in a lot more of a fraught position, and there's going to be some transformation.
I think that
there.
the banks, a lot of this is the banks, if they'd have to kind of mark to market and they'd have to do some in their office portfolio, they're taking losses because it's a 10 cents on the dollar situation.
My
Whereas
problem's your
multifamily, they'd rather not realize those losses.
Yeah.
Where in multifamily, it's more of like, if you're in that situation, the equity is wiped out if you have to transact right now. Or you're getting back just your equity and that's it. But a lot of times, again, a 20 to 30% in decline in value.
Yeah.
Think about the loan to value ratio people were buying at, 70 to 65 to 80%. So again, if values are down 30%, you're basically, that's down to 70%. That's your equity. If you were at a 70% loan to value, the equity's gone, but the lender, okay, they could take the property over and still get back at par if they went out and sold it.
Yeah.
Or they're like, hey, just figure it out for a little bit. But like, they're not taking necessarily a major loss in multifamily, but office they are. So they really don't want to realize the office world. But multifamily might be okay. Now, I think every case is going to be a little bit different because, again, multifamily, there were a lot of transactions at the top of the market where office, there wasn't a real top. I mean, there was a top, but like there was no run up. It was just kind of flat, and then COVID happened and no one wanted to buy office because there was a big question mark. It wasn't like office is going to die, but there was just a question mark. But multifamily, it's like, well, people need a place to live.
Yeah.
Let's keep investing in multifamily. So, multifamily started trading in the 3 caps, low 4 caps.
Yeah, that's
so there's a big swing there.
Yeah,
so
yeah.
I think it's more case by case, but generally the banks aren't as concerned about losses in the multifamily sector as they are in the office sector. And man, all economics, Matt, it's a construct of what we build for ourselves.
Well, no, it's interesting. Like what you said, and this is what I was trying to say is like, it's my problem is your problem. It's with office. It's like, well, yeah, now it's so bad, and I'm in such a bad position as a borrower with this worthless office property that you don't even want to admit it to yourself. I also like, it's like the word realizing is like, oh, you don't even want to think about it. You don't realize, I know has a technical term about
no,
like,
I think you're exactly. I don't think they want to realize it.
Yeah. I don't want to realize. I'm
like that would
ignorant.
mess up my summer European trip.
Yeah.
I would like not to realize this.
Oh man, it's beautiful. I love language. All right.
Yeah. And that's our financial system, folks.
Yeah.
And the United States, we've got the best one in the world. So what does that tell you about the rest of the global economy?
And ultimately, it is worth thinking about how these maturities haven't gone away. You can still think of, even in a year that isn't without the interest rate craziness. Let's say it was 2017. It's still worth looking at what the multifamily loan maturities are in your area. Maybe there's some that are popping up. Like, it's an interesting thing to track outside of newsworthy trends on the subject.
And it's case by case basis. There's a lot of preferred equity in this space right now that if you aren't able to refinance, you can put on some pref equity and kind of live to fight another day. But none of these solutions are free or necessarily even cheap. Taking on risk. And some borrowers have the capacity to do that or not. So
Yeah.
very case by case basis. But the net result of all of this has been, as we mentioned, these price declines.
Yep.
And then so the million, billion, whatever dollar number you want to put on it. And the question is, are we through the price declines? Are we at the actual bottom? Are we at the trough, or are we past it? And I'm starting to think we getting past it unless we see something pop up, or are we approaching that? There could be I'm sick of these phrases. Another shoe to drop.
Yeah.
What could be another shoe? What could
Centipede.
push us down? But I see no shoes.
Yeah. Yeah.
So we've gone to we're grounding with our barefoot lifestyle now, Matt.
Yeah.
Multifamily industry. So I think we'd be past the bottom, and that's why again I believe whether it's now or in the next couple months, we are in the zone of the best deals of the cycle are being done right now. Could prices come down a little bit further in a month? Maybe. But if you buy where they are today, so you're buying 20 to 35% down. So you buy something at 25 and ends up you could have gone down 30. Okay, maybe you've left 5 percentage points on the table, but you're still getting a huge discount to market.
Yeah.
Rather than when it's all clear, the sky is blue and interest rates are low, cap rates are going to be declining pretty quickly, and everyone's already in the market. Everyone's already trying to buy things. It is the competitive. It's interesting. It is still competitive. There's a lot of buyers out there, but buyers are all being weird right now, and again finicky. This deal that we're going to put under contract. I think one of the only reasons we were able to get it, Matt, is because it was like the week that the 10-year was at 4.77%, and everyone was like, "Oh, can't do it." And we're like, "All right, well, we can do it."
I think that as we get into the summer, and rents continue to improve, it's going to become a harder and harder argument to make that multifamily is going to continue to decline, and even into the winter. I think that people's expectations are going to change about the multifamily market, and I also think that we are, yes, it's elevated apartment supply. All these new apartment completions are coming on, but it's going down. The increased apartment supply, it will still be elevated through the first part of 2025, but it is going down. That pressure is lessening and lessening, and I think that that's good news. So we'll have to see how that shakes out when it comes to rent growth and stuff. But even still, rent growth is supporting. It's a lot more positive.
And expenses have been normalizing also.
Yeah.
So this is all good stuff.
That's good.
All right, Matt. We've got 2 more pieces. Let's get through them quick. Let's get to this.
They group together well.
I was going to say they group together really well. Let's talk about some markets, because I was just going to mention this. Different markets are performing differently.
Yeah.
Again, the Midwest and the Northeast has seen relative strong performance, but the Sun Belt, markets like Austin and Phoenix have really struggled. Good, even though they're growing like gangbusters, you built too many apartments. So, Matt, bring us in.
This one's really more about specific regions, and it does pull out Austin, which we'll go over. There's a couple great graphs about that. That's like, oh man, I can see why people did build in this city. But just to kind of skip to it, we were getting pretty comfortable with calling out the top tier performance of the Midwest. And in the back of my mind, I always knew this couldn't go on forever. It does look, based on this report, that the Midwest's time at the top of apartment performance is maybe coming to an end. Now, when that time comes, and maybe it hasn't come yet, the Midwest is not going to crash back down like the Sun Belt. No, that's not the Midwest style. It will politely excuse itself as a top performing region.
Steady Eddie.
And we'll
we never want the top spot.
Exactly. It will steadily slink back into the middle of the pack. And that's and not because it's just because their polite attitude. It's because of apartment supply trends.
Yeah, but then when the other markets decline,
the
Midwest is still growing.
Yeah.
So,
and frustrating, we don't get a closer look at their regional data. It's based off of their top 82 markets. I know that Moody's, a lot of institutions and companies use their research, so I trust it. It's just a little frustrating to not be able to dig in a little bit further. The only example we have of a Midwest market is Wichita, which is their number 3 top performing apartment market. Sorry. That being said, they do have some great information about these different regions, which they split out between Northeast, Midwest, Southeast, Southwest, and West. So instead of a South or Sun Belt, well, whatever. They got it a little split a little bit different than some other people, but the Northeast is the clear standout top performer. No sour grapes here from a Midwesterner. The Northeast multifamily market's doing great with occupancy up 10.10%. And it's the only region with positive rent growth at 0.4% rent growth year to date. That's not year over year, it's just year to date. Still, it's positive where everyone else is sitting on the zero line or maybe slightly negative. Midwest had occupancy numbers were flat, rent growth was negative 0.10%. But I do want to skip down to their materials on Austin. Couple of nice graphs that are covering the population and apartment supply trends in Austin, Texas, comparing it to the national average. And while Moody's repeats the really undeniable point that Austin's overbuilding led to its rent growth cool down, the population growth numbers show just really how tantalizing that city was and maybe still is to apartment developers. You look at right here how much apartment now this is cumulative inventory growth as well as cumulative inventory growth for the United States and for Austin. And Austin is just beating the pants off of the U.S. average. But if you look at the next graph, it shows how employment and population growth in Austin are a lot stronger than the U.S. So if you're thinking, well, if population growth is like, what did I say? It's like 3 or more times higher than the U.S. as a whole. So
these rates are the rates of growth though are a little bit different. You know, the relative, you know, the employment and population growth, while in Austin significantly high, significantly higher than national average. The supply seems to really, I mean, it was really kind of overshadowed that. And again, I think getting over their skis.
Supply is 6 times the U.S. average. Population is 3 times. So yeah, you're about twice as much apartments as you need.
Matt does the math.
Oh, it's just a glance.
and so, and we say that everyone in Austin knows this. Like it's going to get absorbed.
Yeah.
But is it going to be absorbed in time to pay off your bridge loan or your construction?
And I always and I've talked about this for years on this podcast is what when developers want to build apartments and maybe they're thinking about a city. Maybe they're looking at Austin and they're saying, okay, the population growth is about 3 times higher than the national average. How much does that equate to a renter population, and how much should we be looking not just at population but household growth? How do they break down these figures in order for them to project, all right, it's going to be safe to build these apartments here? I know that there's probably some thinking there, and frankly, looking at these numbers, it does seem like, well, maybe the apartment won't be great for the next year or two, but in year 3, it's going to be great because the numbers aren't going down. Austin's still just growing.
I think the challenge is because they do look at all those things: population growth, job growth, the rest, infrastructure. It's not like all the developers, though, are in the same group chat and they're like,
they
hey,
don't call each other.
I'm getting ready to, buy some land and get permits and work on the entitlement for this project. Anybody else building in this submarket?
They pull up all of their equipment. Like, oh, you're here too?
I'm already building 1,000. Obviously, they know some projects that are in the works, and not everything's a secret, and there's announcements, but like, I think there's been some surprise of like, oh, they're also building. Everyone has the same idea,
and
the
they
same
showed
plan.
Up so quickly that maybe it was hard. Yeah, you can't react.
Right, look, we're going to have 10,000. We're going to have 20,000 new residents a year, or whatever, and like we're only going to build 500 units, and so like we just need to get 500 of that 10,000.
Yeah.
But then every other developer had the same idea, and so we're going to build 30,000 units this year. So it's like, all right, you're all going to be fighting for the same group, or there's 40,000, new apartment units that are being built.
And I can imagine, again, like all of them coming in such a short time period where if they just knew, if it maybe was a month before, then they were like, all right, we're delaying.
And that's the thing, again, at the same time, we're having a housing crisis because we don't have enough housing. We didn't build enough housing in the last decade, and we're getting ready to slow down development, with interest rates, and then later in 2025, once all these deliveries finally are delivered. And so it's much needed, but it's like we need much would have rather it smoothed out over the last, over 20 years the 10
good.
previous to the next 10.
Because that's a good segue to the next one.
Okay, let's go to the next one, Matt.
And I would argue we can smooth those out, maybe spread it a little bit to the secondary markets, maybe spread it out, not even just to secondary markets, but to the markets that aren't the flashy Salt Lake Cities or Austins or Portlands. Those are all technically secondary markets, but they're just but they are always placed at a higher, level of attention or popularity for apartment investors than your Springfield, Illinois, or your Peorias, or Cincinnati or whatever.
I think we should maybe come up with a better classification for markets, because a secondary market in Indiana or the Midwest may be different, maybe a tertiary market to someone that's in Texas or like the Northeast or in California. Because like when I think of I see because you have people will talk about gateway markets, and primary markets, secondary and tertiary. And I think there's a lot of kind of overlap. It can be a little confusing. Because, in my mind, Indianapolis is a secondary market. I couldn't call it a primary market. It's not a tertiary market. But then I think of a Fort Wayne is secondary relative to Indianapolis. But I have a hard time calling it tertiary. It's like in between secondary and tertiary. Then there's markets like, West Lafayette or Bloomington, college towns. Can't really call them, if Indianapolis is a secondary, well, that'd have to be tertiary. But then some people would call a city like Fort Wayne, which is the second largest city in Indianapolis. Is that secondary or tertiary? I'd lean towards more secondary. But there's no hard and fast rules. But to your point, Matt, it's where's the capital flowing, and the capital has flown to the what some of the headlines of the articles people read a couple of years ago. Which was population growth and job growth. It's in the Sun Belt, Austin, Phoenix, etc.
Destination. What did I say? Does your market have a cool looking mountain, coastline, maybe a grove of old redwoods?
And does the pension fund recognize it? Have they heard of it? Because like we just bought a deal in Evansville, Indiana, and we were able to raise the capital just fine. Investors were excited about it, but there was an education component in Evansville. I had to start the conversation. How familiar are you with Evansville? Most people were like, not familiar at all. Where is it? I don't know. We had some investors who were just like, we can't make that investment because I'm going to have to convince my investment. I'm going to have to educate my investment committee, and I don't want to do that. Like this market that I know, I've been to Austin. I've been to Indianapolis. I know this story. I don't need to. Everyone has been there. We don't need to tell anybody. And everyone has these same connections and these same viewpoints. It becomes into groupthink. And so the capital is concentrated where they're comfortable going, because they find safety and liquidity, and they want to be in these markets with more liquidity. And then even zooming out from the the larger private equity institutional to domestic institutional capital, it can be convinced to be more comfortable with secondary market. You go outside of that to the international dollars. They want to be in New York City, Washington D.C., Los Angeles, San Francisco, because that's just like what they've heard of those places. Like they don't know. Like Chicago is like, ooh, we're gonna go all the way into that's like going off on a safari.
For real.
Indianapolis they're like, that's the suburb of Chicago?
Practically.
Yes. Because if you've when I travel like in Europe or when I've been to Asia, where are you from? I have to stop saying, oh, I'm from Indiana, I'm from Indianapolis. I'm like near Chicago.
Near Chicago.
And that's not technically correct, but I don't live in. I'm not from Chicago.
Now just to kind of ground this with some stuff from this article, their point basically was that these lesser popular, these less attractive or whatever you want to say. Those are the ones that are seeing positive rent growth, and not necessarily the ones in the South or the Sun Belt. There's a big quote, and I'll just quote it right here. 9 of the 20 markets that have had rents fall since the beginning of the year are in Florida or Texas, and other pandemic high growth markets like Atlanta, Raleigh-Durham, Austin, and Salt Lake City also have average rents that are lower today than they were at the beginning of the year. On the other hand, many secondary markets in the Midwest, Northeast, and South are still seeing strong growth in asking rents. Albany, Milwaukee, Springfield, Louisville, Cincinnati, Des Moines, Richmond, Madison, Portland, Maine. not Portland, Oregon, Lafayette, Ohio, Youngstown, Providence, Northern Virginia, Scranton, Wilkes-Barre have all had over 2% growth so far this year. The only market with such growth that is not a secondary market in the Midwest, Northeast, or South is Honolulu, which is an outlier at 5.7 growth. I think we talked about this last year or last week or the week before, how Honolulu was that outlier, for whatever reason.
Sure. Yeah, exactly. It's like, all right, it's not going to probably affect us.
But I do think that it is interesting that, all these places like Cincinnati, Louisville, Milwaukee, they're not going anywhere. And some of them have beautiful places. Maybe there is a lake in driving distance.
Well, and this is what the coastal international capitals get, is like the suburbs are blowing up in all these markets.
Yeah.
And even the cities are. Because, again, the manufacturing jobs, the high-tech jobs that are coming to these markets because the cost of living is... I mean, San Francisco is a hard place to live from just an affordability standpoint. In the Midwest, you can afford to live. You can afford to live like a really nice life. We have natural resources. We have water. We have low taxes. We have plentiful jobs. We have a labor pool that is educated and trained. It doesn't cost what a California labor cost is going to be. Yeah. And we're not going to have hurricanes or earthquakes either. So it makes a lot of sense, and that's why EVs, batteries, semiconductors, solar panels, they're all going to be built in the Midwest, and a little bit outside of Phoenix and in Tucson also probably. But this is where this manufacturing reshoring boom is taking place right now. Yeah. And this is it's going to take 5 to 10 years to build out all of this. The data centers, that's where it's all going. And so we're looking at again, it's not this year. We're looking at a good 15, 20 years of growth. And that's why the folks, like I've heard
There's a Carl Whitaker?
Well, no, not Carl Whitaker. I think the CEO of Yardi at NMHC was saying, again, places like Indianapolis and Columbus, Ohio could be the Austins of this next decade.
Interesting.
Because Austin a decade ago was not the Austin it is today.
And driven by low cost of living, low cost for businesses to come here, and a economy and a workforce just as stable and just as able to absorb. It's not like these aren't derelict towns, whether it's Indianapolis, Cincinnati, or Cleveland or whatever. They're perfectly healthy. They are primed for growth, and it's cheap. People are catching on too.
Yeah, there's a huge value.
Yeah.
Nashville's a great example, Matt. We've talked about this before. I looked at moving to Nashville before I moved back home to Indianapolis. Nashville is a cheaper, more affordable place. And that was one of the drivers I was thinking about. It's like a cheap place. I can rent a house. And I can remember I could rent a house cheaper in Nashville than Indy. No longer the case.
Wow.
So Indy's got some catching up, but it's on that trajectory. And because again, now if I was like a young 20-something looking at Nashville, I'd be like, how the heck am I gonna live in Nashville? Yeah. It's like comparing New York City and Nashville. Like I'm basically paying the same rent these days, maybe a little bit less in Nashville, but not much. So it's fascinating. Matt, happy birthday.
Oh, thank you.
The big 4-0. That's really exciting.
Wouldn't be spending it any other way than on the Great Report.
Yeah. So everybody wish the doctor a happy birthday, and make sure you can hop on over to graycapitalllc.com, especially if you're an accredited investor. Create an account on our investor portal. We're getting ready we're going to update everybody here in the next couple of days on our latest deal. So if you want to take a look, even if it's just to learn about multifamily, you have to be an accredited investor, but do that, and then schedule a meeting with us, and love to talk to you on a call, hop on a Teams or Zoom or whatever you want to do, and would love to partner with you, or just subscribe to this YouTube channel, hit the bell icon so you're going to get the updates. We appreciate all the comments. We'll bring up some comments at the next episode, and why don't I say happy birthday on this birthday episode? All right, have a great week. We'll catch you on the next episode of The Great Report.